Should I break my mortgage or not? Well, the answer to this is not as simple as a yes or a no, but let's explore this today so that we can come to a better conclusion. Hi guys, my name is Navjot Gahley, and just as a background, I am not a mortgage professional. What I am is an advisor. I am a financial and wealth advisor, and of late, a lot of people here in the British Columbia region of Canada have been asking me this question. We have a high rate, we have maybe a 6 plus percentage rate on our most recent mortgage. We're locked in for the next 3 years. Should we break that because interest rates are going down, mortgage rates are going down? Should we actually break that? Will we be able to save some money? Now, not as easy as a yes or no as I mentioned before, but all across Canada, a trend that we're seeing right now is mortgage rates are coming down. The Bank of Canada, they've announced bumper rate reductions of late, and they're expected to continue to reduce the rate, one in December and throughout 2025 as well. Again, nobody has a crystal ball and we cannot talk about the future. We cannot predict the future, but this is educated guessing, right? Now, if you're one of those people who is stuck, quote unquote, with a mortgage that is maybe 6 plus percent, around slightly higher, slightly lower, and you look around and you figure out, and it's true, right now there are rates, Global Mail covered it, some lenders are actually offering rates that are close to 4%. But I think most lenders, it's easy to say they're below the 5% mark or around about there. So at least a 1% differential. Should you get out of your 6 plus percent mortgage and get into a 5 or thereabouts percentage mortgage? And it's a very important question because somewhere maybe related to your 6 plus percent mortgage is an outlay every single month, a monthly mortgage payment that you feel like it's quite high. What do you can do something, you want to do things to actually reduce it. That's one thing. The other thing is, there is also a penalty, because this is how fixed rate mortgages work. If you are on a fixed that is maybe even 3 years, they do charge a penalty for breaking that mortgage. Now the question is, are you coming out on top if you consider the interest rate savings, number one, over time, so going from 6 to 5, if you also consider the interest rate differential penalty that you'll have to pay once you break that fixed rate mortgage, and all of that has to come together for you to say, you know what, all of this makes sense financially and I'm going to go ahead and do it. So that's the question to ask. Some considerations that you got to think about. One of the major things that one has to think about is some of these lenders, they actually have clauses in there where you cannot actually refinance and go to a different lender. Now in that case, your options might be a little bit limited. The other thing that you have to consider is you might be wondering, if there is a rate cut coming, if there's more rate cuts coming in Canada, for example in December, then why don't you wait? That might be something that's going on in your mind. Hey, if that's something that's going on in your mind, I don't blame you. However, understand this, the interest rate differential will change as well. And what will tend to happen most likely is that your termination charge on your current mortgage is going to continue to increase. So maybe at one point, it just won't make sense. Yes, the interest rate will decrease, but you want to come out on top. It's not about the plain interest rate. It's about how much better off you are versus where you are currently, right? So that's what you got to think about. Now, the other thing to think about as well is, now that you decide, let's say, you decide you have a mortgage, you have a 6 plus percent rate, you come down to maybe 5, below 5, and now you're maybe saving $200, $300, $400, $500 every single month. The other important question is, what are you doing with that money? Cash flow coming to you is great only if it is useful. So if you're going to use that cash flow to actually go out and go for vacations, hey, you know what? Don't stop yourself. But remember, don't continue on those vacations. Don't continue to buy those expensive things. Invest that money. That $400 to $500 over the next maybe 25 years, assuming your initial term was maybe 30 years old, 30 years for your mortgage, 5 years have passed, or whatever the case is, maybe the next 25, maybe the next 27 years. The good thing is that money can become multiple fold, and that's where compound interest comes in. Add it to your long-term savings, to your long-term compounding money, because if you do that, that's where the real benefit will be seen. Yes, you save interest, but again, there's two mindsets, right? One mindset says I want to save money, the other mindset says I want to make money from money, and that's the wealthy mindset. So if you want to know more about how you can double, triple, 4 times, 5 times, multiple times that income that you've now saved from coming to a lower rate, I'd be happy to guide you. I'd be happy to show you what some options are, and how the numbers might actually look like 20, 30 years into the future. Because trust me, it's not about what you got today. It's also about what you're building for the future, right? So with that, I hope this episode answers some of your questions about whether you've got to break your mortgage or not. With that, I'll come to you next time with something new. Peace.